Union Budget 2023 is out and the markets have spoken by falling drastically yesterday. We have with us Sahil Kapoor from DSP Mutual Fund to tell us where does the market go from here after the budget 2023. Sahil, thank you for joining us.
Thank you, Shaleen. Thanks for having me.
Sahil, your very quick take on the budget.
So quickly, I think the budget was overall a good overall take on the economy plus government finances. So what usually I like about the budget, specifically those budgets which are not very disruptive, where we don't see any major tax changes or any major changes which can disrupt the momentum of the market or of the economy. And yesterday's budget did not do any of those things. Secondly, if you look at the numbers which were presented, all of them appear to be in line. You can tinker and critique a few numbers here and there for a few things. But on balance, I think the numbers were okay. They seemed achievable, nothing out of the ordinary. Even the GDP numbers that the government has assumed seems reasonable. So on the whole, I would say there were no self-goal. It was a kind of a no-nonsense budget. And that's why I think it's a budget which will probably put us in good stead.
A number seeming achievable, you say, where will the 10 lakh crore of capex come from?
See, largely it's not just about capex, it's about the overall kitty, and government has pegged in at about 45 lakh crores of the overall expenditure if you look at that number. And when you look at it from the lens of where that money is going to be spent, so you put it in revenue expenditure, which is RevEx, and the other is capex. So what you're asking is where the 10 lakh crore capex is going to come from, right? So largely it is going to come from the overall kitty of the revenue that the government is generating. But two details I want to put here. First is that the government has said that its capex is going to increase from revised numbers of 7.28 lakh crores to about 10 lakh crores. So a very large jump of about 1/3, right? But when you look at the revenue expenditure, last year on the revised scale, revenue expenditure was 34 lakh crores. So they have raised it only by 1 lakh crore. A very, very small marginal increase there, right? So when you say that capex is very high in comparison to last year, the revenue expenditure is lower, and therefore it is balancing out. Plus, I think when you look at the revenue sources of revenue that the government is getting in terms of taxation, all those numbers appear to be believable. Overall, they are saying that the revenue pool will grow by about 12% on a GDP growth of 10.5%, or nominal GDP growth, which is okay. You could critique that it could be up and down by 0.5%, but I think that number is okay. That it's quite possible when you do a bottoms-up number. So there are sources of financing which is available for the government, and I think they can do this capex number. And what interesting hit me is that last year we were doing about 50,000 crore rupees a month in capex. This year that number could go to 80,000 crores, right? Which is a sizable jump. And I think that is something that we should be aware of, that why this number is important now.
Why did the market suddenly rose after the budget and then fell sharply after that?
Very difficult to explain intraday movements of the market. Largely, it is dependent on how market participants or short-term traders are positioned. And if you look closely, large part of the market got more volatile because of the ongoing issues with the FPO, etc. But on the whole, I think the market would sense that this budget doesn't have anything specific to spook the market or make it very exuberant, right? So the market will eventually focus on other things, which are earnings growth and how earnings will pan out eventually. So from that lens, I think it's a okay budget. Market should not be really worried about the implications, so to speak, of the budget. In the short term, I think market is still in a phase where valuations are getting worked off, right? So last year, India was at a 90% premium to emerging markets. So that I can tell you the date also. About 10th October, we were at 90% premium to emerging markets. Today, that premium is just about 50%. Our long-term average is we trade at a 42% premium to emerging markets. So from a 3 standard deviation in terms of our expensiveness, we've come down below 1 standard deviation, or we are getting very close to the average. That is the kind of correction or consolidation which has happened. So I think this is partly that market working out the excesses in terms of valuations.
Last time we spoke, that was around that time only, and we spoke about valuations as well.
Absolutely.
So you said markets are at about 50% premium to emerging markets right now, and which is slightly higher than the long-term average. Does that mean more scope for either a time correction or a points correction in the market?
So I think we are going through time correction. So there is no reason to believe that we will have an increase in our PE multiples. So those multiples are eventually shrinking. So when you look at the numbers right now, today we are trading at about 20.6 times trailing earnings. About 1.5 years ago, this number was 27, right? So there has been a sizable decrease. And in terms of forward earnings, everybody has their own estimates. But if you look at the collective consensus estimate, we will do about 1,000 rupee EPS in 2024. Now, whether we'll do it in January or December, I don't know. Nobody knows, right? But if you take that number, then today we are trading below 18 times that number, right? And we haven't traded below 18 times at least since COVID began, right? So valuations have come down. Is there room for them to shrink further? I think they will shrink once earnings growth picks up even more, right? So I am not too concerned about valuations now. As much I was concerned 3 months ago or 6 months ago. I think now we are okay. We are in a bucket where you don't have to pay a lot of attention to this number, and you could pay more attention to earnings growth now.
I'll just pay attention to it for 30 more seconds. You said 18, number of 18. How does that compare with the long-term average in the past?
So we are at close to long-term average. So if you were to, and you have to split it into two ways. If you go from, let's say 2000 to 2010, our 1 year forward average will be closer to 16.5, 17 times. When you go from 2010 to 2020, your average will be above 18 times, right? But when you look at the full data set, you are somewhere at 17.5 times or so, right? So we are closer to that number.
Okay.
And I think we are comfortably there. But you have phases where, valuations have declined significantly when there are market crashes and other reasons for the markets to sell off. So once those sell-offs occur, become really cheap. But nobody can predict when those events can occur, right? So you have to do with average valuations.
Sure. Okay, coming to budget announcements, what sectors do you think will outperform and which ones will underperform?
So largely it's a long shot to say what sectors, reason being that there were no specific sectoral changes other than saying that the broader sector where capex heavy industries there, whether it is industrial, FMIG or road construction or building materials, on whole, this sector has been doing well for the last 2 years, at least 1.5 to 2 years. Yesterday's announcements made sure that this cycle continues. So I think that is one sector which should benefit in terms of government expenditure because it's a large part, right? I told you the numbers. Government expenditure is a large number in these sectors, so that should continue. Second, I think one sector which is cheap, plus there are, there is momentum, there is clarity in balance sheet, which is the BFSI sector or particularly the lenders, that I think will benefit. So if you don't have any stress from government finances and if your economy is doing well or growing at a steady pace, this is a sector which usually outperforms everything else. So that is again a sector which I think should do well. So from the budget perspective, these two sectors appear to be the clear winner, apart from smaller sectors which are part of the capex theme, which is defense and other small chemical companies. So I think these are the two takeaways from the budget. X of budget, there are many other things to look at.
You said BFSI sector will do well if, there are no concerns from government finances, but are there any other concerns on banks and lenders right now?
I don't think so that there are any significant concerns. So even if you look at valuations, they are trading at about 1.88 times 1 year forward price to book, which I think is one of the lowest valuations X of the March COVID crash. We've seen a very long time. Balance sheets are healthy. Credit growth is healthy. There are some concerns around, the recent developments, but I think they are far-fetched. Overall, the numbers don't appear to be very large, but you can never ignore these factors, right? You can always see that there are certain contagions that can occur in financial markets. But for now, I don't see any significant indicators which are flashing red. But we have to be very, very careful in analyzing these trends. As of now, I think the answer is no, but it can certainly change in the future. But for now, I think we are okay.
What's your take on the asset quality right now?
So asset quality is progressing very well. Overall, we've seen that banks have been reporting numbers where GNPA ratios are falling. And recently, RBI published its report on the quality of growth or the balance sheets of all the lenders put together. So the GNPA ratio has fallen to about 5%, and it's possibly going to slide towards 3.5% in FY24. So on the whole, these numbers are very encouraging, and I think that makes this sector quite robust.
A huge capex from the government, 10 lakh crore capex, effective capex of 13.7 lakh crore. What does that do to private sector capital expenditure? Does it crowd out, or does it draw even more private sector to jump into the bandwagon?
So largely, see, I'll tell you that Government of India usually exercises what is called pro-cyclicality, right? That means they try to accelerate a cycle if it is doing well, and that is what they are doing here. And capex is certainly a theme or an event which doesn't crowd out the private sector. It's not like borrowing, right? So if the government is spending more money, it usually encourages the private sector also, because eventually that money finds its place into the hands of private corporations through business activities. And I think that is the reason why capex cycle is something that usually the government has to kickstart and then the private sector takes over. So these numbers are encouraging, and we should not forget that government is just about 8 to 9% of the overall capex in India. It is the smallest contributor. The biggest is household, and then there is private non-financial corporations, right? So those two anchors are still very, very large. Government is just an enabler, and they have done their job. The private sector should take over from there, I think.
And most of this capex, any particular sectors where this capex you think will be consumed the most?
So largely, when you look at the 10 lakh crore number, 75% of that goes to infrastructure, which is road, railway, ports, etc. And that is the sector which benefits the most, because government's expenditure is centered in these sectors. So you could assume that these sectors will benefit a lot more than everything else. So when you look at railways, when you look at metros, when you look at electrification of railways, when you look at ports and roads, all these companies who are involved in the full value chain, they will be the beneficiaries of this kind of expenditure.
FIIs have turned net sellers in January, 40,000 crore.
Yeah.
Does the budget contain anything that will bring FIIs back?
So my sense is that at the beginning of the year, I wrote that this year FIIs will make a comeback to India, and January hasn't really been kind to that expectation. But I think usually if you go back in time and see December or January, either of the month, FIIs reset their earnings expectation in each market. And these are usually the flows which are caused by rebalancing. And last year, the whole of 22, other emerging markets were seeing significant outflows, while India did not see a large outflow post June 22, right? Last 6 months, we did not have any excessive outflows. I think there has been a rebalance. When you look at MSCI Emerging Market Index, it's up about 27% over the last 3 months, and we are up 0%. We haven't done anything. So there is a rebalance which has happened. As we progress during the year, I think FIs will make a comeback to India, which I think right now I am in rarity, where not a lot of people believe that will happen. But I believe there are enough reasons. Our valuations are now much more attractive than they were last year. Earnings growth is still steady. Economic growth is good. We haven't scored any self-goal this year. So there is no reason for FIs to remain in abeyance. I think they will probably come back to India.
Any overhang of the upcoming elections on the markets?
So there could be, of course, there is a large political risk associated with these events. And there is also the question mark of continuity of economic policies. For now, I think it's very, very difficult to make a judgment on what kind of risk do FIs or investors are pricing in. I think as we get closer to the event, it will become more apparent. One thing I can make an educated guess is that historically what we've seen is that most governments continue the economic policies of the previous government. So if you look at schemes and how they're implemented, you don't see major changes. You do see major changes in terms of narratives, but eventually the spending patterns and the major outlays don't change a lot, right? So that is something we should be mindful of. But for now, I think the election-led volatility is some time away, maybe 6 months away from us, and then we'll have to reanalyze it.
Sure. Actually, you're talking about what happens after the election. I was talking more in terms of in the run-up to elections, what kind of experience would the markets go through?
So if you remember in 2013, in the run-up to elections, market had bottomed out and there was a very, very strong rally, maybe in the expectation of a change at the center. So this time around, we have a stable government, a majority government. If the market sees a majority government which can act and make policies, it will probably remain very stable. If there is an expectation that we are going to see massive changes in terms of leadership, then probably market could get very nervous.
Sure.
So these are the two assessments. They are not very outlandish thoughts or nothing great deep insight in what I'm saying, but that is what it is. I think that is how the market should probably behave.
The new tax regime, which the government is now pushing forward pretty hard, not by a dictate, but by way of incentives or nudges, so to say. The new tax regime doesn't have incentives for the traditional instruments such as ULIPs or insurance, other kind of things. Number one, what does that do to the money flowing into the markets? And then secondly of all, if people don't invest that money into such kind of instruments, where does that money go?
Sure. So I think the second question that you asked is more important in terms of where this money will eventually go, because it now is becoming a consensus that the government wants to move to the new tax regime because it's more easier, right? You don't have to do anything. It's more direct in nature. My guess is that all asset classes should have very similar taxation, which is again a very, very important issue not addressed right now. And secondly, these nudges of saving taxes for investment, eventually they will go away, right? And they should not be the fundamental reason for you to make an investment. It's actually it's very counterintuitive. If you're making an investment to save tax, maybe you're not making the right investment, right? So from a purist point of view, this is a very good move. It will probably hurt us in terms of how we operate our savings, and it will maybe kill some old products and create some new products. But on the whole, eventually it will be beneficial for investors because they will start investing for their requirements rather than for saving tax. So I think that is the biggest takeaway. And as I said, some old products which have become very large because of their nature that they save tax for individuals, eventually once these changes occur over the next few years, they will slowly die down or change their avatar. That is what is going to happen, but new products will take over. So I'm not really concerned about the industry as a whole. I think it will probably get more flows rather than less flows because people will become more aware in terms of how to do their investments.
So more direct flows into markets, more people directly investing into equity markets?
That's the trend which is maybe taking shape at a gradual pace over the last few years. But if you think about it at another level, once you remove the possibility of getting exemptions in taxation, then you are really, you really have to think very hard on where to invest and how to invest. So I think financial advice will become even more important, right? So at one point, you could see that a lot more investors directly jump into stocks or directly go for mutual funds without a financial advisor. But I think the worth or the input or the insight which will come from financial planning will become even more crucial once you shift to exemption-less tax regime.
Last leg of our conversation. So considering what we have spoken about, budget announcements, capital expenditure, upcoming elections, considering all that and valuations, of course, what should be a retail investor's strategy over the next 1 year in terms of position sizing and in terms of investment pockets? Where should one invest? How much should one invest? And at what frequencies, what kind of dips?
See, if you're a new investor, if you have new 100 rupees today, and if you have a moderate risk appetite, that means you don't want to have drawdowns beyond 10-15%, then possibly you should stick to 50, or maybe right now go a little overweight on equity and go to 55% equity. And debt is also offering handsome returns today. on certain debt instruments. For example, a 3 to 4 year constant maturity active fund will probably give you 7.5 to 8%, because interest rates are quite high and probably at the peak, right? So you allocate another 30-35 rupees to that, and maybe allocate around 5 to 10 rupees to gold or the alternate investments, or possibly international equity. I think that should be the flavor right now for a moderate investor. If you are not risk averse, if you want to take more risk, probably you should keep increasing your equity allocation. If markets continue to remain here for another 1 or 2 months or dip even more, then an aggressive investor should actually take its portfolio to 70-75% equity. I think that should be the overall complexion. So you should be overweight equity if you see more decline, because we are in a bull market for the next 2 to 3 years, and possibly investors should remain invested in equity.
Overweight equities, if you see more decline, how much more decline?
I don't think we are going to see any sharp declines like maybe 2020, unless you have a crisis, which I can't predict. But I think we are possibly, if you look at the numbers, if Nifty were to trade at 17,000 or so, maybe closer to those levels, it makes a lot of sense to be overweight on equities.
Sure.
Because of past numbers will be below average valuations.
Sure. And within equities, which are the pockets that one should be one should invest more? And also position sizing. Should I hold some of the cash right now, or should I increase the positions in equities now?
See, cash is a very, very individual call, because it depends on what is your emergency fund status, etc. So I would probably club cash with my debt component, which I explained earlier, the percentages. But in terms of sectors, I think there are, if you do the pecking order, probably you will put lenders, financials at the top, and then healthcare, pharma at number 2, and then auto and consumer discretionary at number 3, and then possibly engineering, industrial goods and infrastructure at number 4, and so on and so forth. So these are the themes and sectors which will probably do well. So when you pick your funds, look at where these funds are investing. All the fact sheets give you very clear idea of the sectoral weights of each fund. Secondly, look for those funds or investment strategies which are in valuation respecting, right? There are a lot of strategies which could probably show you very high returns, but when you look at the portfolio, the valuations could be really, really high. So you can avoid that and probably look at mutual funds which are valuation respecting, with a good blend of all the sectors which I told you.
Very interesting. You put infrastructure at number 4 here, despite that massive capital spending that we spoke of for about 15 minutes of this conversation.
Yeah. The reason is that last 1.5 years, we've seen a stellar rally. And when you look at a very, very top-down kind of a view, you will have to then go deeper and go to each sector. For example, if you were to look at gas distribution, then it might jump and come to number 1, right? But when you look at, let's say, industrial product companies, they have had a huge rally in the last 1 year. So you can't really be very, very overweight there. You could be slightly overweight, but not very heavily, right? So it's a more bottoms-up call when it comes to this sector, because it has been doing very, very well. So your entry really matters. And all these bunch of sectors are still sectors where you are allocating a large part of your money. So it pays to be a little more critical in terms of which type of companies you pick.
Last questions. Your Nifty target for next 1 year?
I don't have a Nifty target per se, but the numbers that I told you, if they come true, if you hit 1,000 rupees EPS in 24 sometime next year, then on a trailing basis, Nifty trades at 20 times very easily, right? So I think that's the logical target where Nifty should head towards.
One final question, if you want to answer that, what happens to Adani Group stocks from here?
It's a difficult question. At our fund level, apart from the passive schemes which follow the index, we haven't really had any significant view on the group. So there is another set of businesses that we like, which is, as I said, more in line with the frameworks that we run, and we are focused on that segment right now.
Sure. Sahil Kapoor, thank you so much for joining us today.
Thank you, Shaleen. Thanks a lot.